This is question number 4 of homework 1 for chapter 2, problem 2-12. Freeman Incorporation reported the following financial statements for the last 2 years. So here we are provided with the income statement for 2017 and the 2 years balance sheets for 2016 and 2017. So requirement 1, calculate the operating cash flow. So operating cash flow we can calculate from the income statement, right? Income statement. And operating cash flow, you can use multiple tools to do that calculation. You can use a calculator, either scientific calculator or financial calculator. You can also choose to use Excel, and that's my choice here. And the reason will be clear very shortly. So one thing about using Excel, one thing which is good about using Excel is that you can actually copy this table directly to Excel, so you don't have to type it yourself. And see that now the numbers are in this table. We just need to calculate. So we start from sales and cost of goods sold, selling and administrative expenses, and depreciation. So then we arrive at the EBIT, which is the sales minus the cost so far, including the depreciation. And then we subtract the interest, and then we get to EBT. And then we subtract the taxes, then we arrive at the bottom line of the income statement, which is the net income. And then we know that from the net income, we can either a portion of the net income can be given back to shareholders in the form of dividends, and remaining is retained inside the firm in the form of the retained earnings. So this is the addition to retained earnings. So that's a general income statement. So from that, we can calculate the operating cash flow, which is EBIT. You can go to my lecture slides, find out the formula for this. Check my lecture PowerPoint slides. And so operating cash flow is this is the operating cash flow. So here's the operating cash flow is, we start from EBIT and then we add back depreciation, because depreciation is not a cash outflow, right? Even though we deducted this as an expense, but in terms of cash flow, we should add it back minus the taxes. So this is the formula for that, and we should EBIT is right here. This equals EBIT. Add back the depreciation. Depreciation is right here, and subtract the taxes. Taxes right here. So that's my operating cash flow. We can just directly copy this number back to our Connect operating cash flow. And what's another cool thing about using Excel is that it automatically meets this rounding requirement. Do not round intermediate calculations. Requirement 2, calculate the change in net working capital. So to calculate the change in net working capital, we can still copy this 2 years balance sheet. Yeah, now we need to use the information from the balance sheet rather than the income statement. So in order to calculate the change, we first need to calculate the level, right? The level. So NWC, so let me write down the level here. NWC, this is 2016. The different definition of NWC is that it's the difference between the current assets and current liabilities, right? So current assets for 2016 is here, and current liabilities is just accounts payable here. There's no other current liabilities for this firm. So the difference is simply this current assets minus the accounts payable. So that's the number. And for 2017, we can do a similar calculation. NWC 2017. This is current assets. It's right here minus the current liabilities, which is the accounts payable. Yeah. So that's the level, and then the change in NWC is simply the 2017 level minus 2016 level. So we just copy this number back. That's the change. Requirement 3, calculate the net capital spending. Net capital spending. We talk about 2 ways. We can do the net capital spending calculation. First is based on the gross fixed assets, right? That's the change in gross fixed assets. If we check our next slides. So the net capital spending is 2 ways. First one is the change in gross fixed assets, and second way is the change in net fixed assets. So net means that it's gross fixed assets minus the accumulated depreciation, net fixed assets. And then we need to add back the depreciation expense. So this depreciation is the depreciation over the year, right? It's not the accumulated depreciation. So that means this number should come from the income statement. So now let's back to our example and see here we are only provided with the net fixed assets, and you can find the depreciation from the income statement. So we can use the second way to do the calculation for the net capital spending. So now let me do it here. Yeah, let me do it down here. So net capital spending, that's the change in net fixed assets. So this is the 2017 level minus the 2016 level, and then add the depreciation. It's right here, and that's my number, net capital spending. So copy this number back, and that's the answer. Requirement 4, calculate the cash flow from assets. So now we have the operating cash flow, we have the change in net working capital, and we have the net capital spending. So we have every input that is necessary to calculate this cash flow from assets, operating cash flow minus the change in net working capital minus the net capital spending. So we can do that calculation pretty straightforwardly. CFA, cash flow from assets, is simply the we go back to our operating cash flow. It's right here, and then minus the change in net working capital right here, and minus the net capital spending. So it turns out to be a negative number. So negative here means that the firm on average actually on aggregate actually doesn't pay out cash flow to its investors. It's collecting money from the investors. That's what this negative here means. Requirement 5, calculate the cash flow to creditors. So in order to calculate the cash flow to creditors, we need to understand what are the types of cash flows that creditors can get. The first type is the interest, right? For the firm, the interest is an expense, but for the creditors, it's their income. It's part of their income. Other than interest, there's another source of cash flow to creditors. That's when the firm issues more debt or retires some of its existing debt. So in aggregate, that's called the net issuance of debt. So if the firm issues more debt, that means the firm is collecting money from the creditors. So from the creditors' perspective, that's a negative cash flow or cash outflow. So that should in terms of the cash flow to creditors, that should enter negatively. So if we check our next slides, you can find the formula turns out to be cash flow to creditors is the interest. And so this is the retirement of debt. We should add this number. So if this is the issuance of new debt, then we should subtract this number, right? Interest. In other words, we should subtract the net issuance of new debt, which is the issuance of new debt minus the retirement of existing debt. So that's what we can find the information on the level of debt from the balance sheet. Yeah, we can check the change in the long-term debt. That's the net issuance of new debt, and the interest is from the income statement, right? Interest is right here. So we can do the calculation cash flow to we call that to bondholders or the creditors. Here I'm to be consistent with the terminology used in the next slides. I use CFB to stand for the creditors, cash flow to creditors. This equals for creditors, interest is an income. So the income and then minus the change in the, so it's change in the long-term debt. So that change is the level of 2017 minus the level of 2016. That's my change. So that's my cash flow to creditors. So copy that number back. And the final part of this question is calculate the cash flow to stockholders. Do not round intermediate calculations. A negative answer should be indicated by a minus sign. We have the same rounding requirement for requirement 4, and it turns out we have a negative number here, so we correctly entered the minus sign before the number. So to calculate the cash flow to stockholders, we also need to understand what are the types of cash flows that stockholders can receive from the firm. The first type is The creditors receive interest, the stockholders receive dividends, right? So the first type is the dividend. And dividend is available, right, from the income statement. And the second type, similar to the creditors, is that when the firm is issuing the new stock, so for the firm, it's collecting money from the stockholders, and for the stockholders, it's paying the money. So from their perspective, that's a negative cash flow. And when the firm is retiring the existing, repurchasing some of its existing stock, then it's the other way around. So that means the net issuance of new stock should enter negatively in the formula. But the problem in this question is that actually this way doesn't work, because in order to use this way to calculate the net issuance of stock, we need to also have the more detailed items within the owner's equity, because owner's equity also include the retained earnings, but we don't know the retained earnings, so we also don't know the um, uh, capital surplus and par value of the capital, hence that's the equity level. So we cannot use this this way, the what I call the conventional way to calculate the cash flow to stockholders. And then how can we solve this problem? We can solve this problem by using the so-called cash flow identity. So the cash flow identity simply means that cash flow from assets equals cash flow to bondholders or creditors plus cash flow to stockholders. So this is the cash flow identity. From that, you can solve out cash flow to stockholders pretty straightforwardly. So it's CFA minus CFB. Okay, so now we have the CFA and we have the CFB. So CFS, cash flow to stockholders, is simply the CFA minus CFB. So it's an even larger, in absolute terms, negative number. So this negative here means that on net, actually over that period, stockholders pay the firm, perhaps due to the firm issuing more new stock, and that's the driving force which makes the cash flow from assets to be negative, because the cash flow to creditors is positive. So this means that over that period of time, the firm actually is paying its creditors on net rather than collecting money from the creditors. So that's question number 4.